Good morning, welcome to Market Wrap number 132. Stuart Williamson here at the helm. This is just one of our mediums for sharing information on the UK market and others. The areas we cover as well as this are the podcast and the World Wide Web. Please do subscribe if you like, go onto the website, have a look, and you get more of these updates regularly. Almost a new year, and just as 2020 and 2021 were surprises, so has been 2022. Hopefully next year will be less turbulent. This week I'm going to cover what the market is saying about the UK market currently and what's going to happen going forward. To get this information, we're going to use the Telegraph, nationwide reports that are just out, and Zoopla reports that are just out. So the Telegraph, carnage in the buy-to-let market. They say inflation is expected to fall sharply in the middle of next year, and mortgage rates are already in descent and will continue to fall, perhaps down to 4.2%. But what is the extent of the damage that's already done in the UK's housing market? They say basically that house price falls have gained pace in some areas, and basically mortgage rates are causing this, reducing borrowers' buying power. Some landlords, or in their case they say many landlords, are selling up as the fixed rate deals expire and higher mortgage rates affect their profit margins. Buy-to-let investors across the country, apparently, are rushing to shed loss-making properties. But landlords in locations such as London will be affected most, and other areas where rental yields are not up around the 5% plus mark. This highlights the importance of buying in a high-yield location. If we take the example quoted in the Telegraph, a lady called Charlene Dean, a landlord near Bristol, she's just come to the end of her fixed-rate mortgage, and a £930 per year profit will suddenly become a £4,980 loss. The buy-to-let landlord issues will also have repercussions for tenants who could find themselves evicted if owners leave the market. Also, renters looking to buy will be met by a systematic housing shortage, which is keeping younger generations off the property ladder. What's causing this, as we said, it's about the affordability of mortgages, but also they say the number of homeowners with at least 2 bedrooms has surged to 8.25 million, a jump of 959,000 since 2017, according to the English Housing Survey. They report that it now means that there are now at least 16.5 million unused bedrooms in owner-occupied homes across England. This does not include homes which have fewer than 2 spare rooms. More than half the homeowners live in under-occupied homes. Between 1997 and spring 2022, the share has jumped by more than a third, from 39.4% to 53%. By contrast, over the same period, the share of private renters and social renters fell by 20% and 17% respectively. So what does all this indicate? Rental rates will continue to rise, and if you bought in a well-capitalised format, as we advise our clients, then you'll benefit from this. Now, if we move on to the nationwide, what do they say? They say a soft landing is still possible. In summary, the housing market has remained remarkably resilient, with annual house price growth in double digits up until the mini-budget, thanks Kwasi Kwarteng and Ms Truss. Hard for the market to regain momentum with economic headwinds set to strengthen, and a relatively soft landing may still be achievable in 2023 with activity stabilising modestly below pre-pandemic levels and house prices edging lower, perhaps across the board to 5%. Robert Gardner, Nationwide Building Society's chief economist, looks back on the housing market in 2022 and looks forward to what we can expect in 2023, and he quotes, "For the first 3 quarters of 2022, the housing market was remarkably resilient. For much of the year, activity levels remained at or above pre-COVID levels, with annual house price growth in double digits, ranging from 10% to 14.3%. Despite intense pressure on household finances from surging inflation and a steady rise in mortgage rates. Between January and August, the average UK house price increased by almost 20,000, from 255,000 to 273,000. He says this performance was all the more surprising since housing affordability was already stretched in a number of important respects. In particular, deposit requirements had become increasingly onerous as a result of house prices outstripping earnings by a wide margin in recent years. A 10% deposit on the typical mortgage on a first-time buyer property increased to almost 60% of annual gross earnings, an all-time high. But, he says, the financial market turbulence which followed the mini budget at the end of September represented a major shock to the housing market, and it did. Our phones, if they did ring, stopped ringing. The number of mortgage applications slumped towards the low seen at the start of the pandemic as a spike in long-term interest rates quickly fed through to mortgage rates and fundamentally changed the affordability dynamic for prospective buyers. For example, when mortgage rates moved towards 6%, the monthly mortgage payment on a typical first-time buyer property bought with a 20% deposit increased to equivalent of 45% of an average worker's take-home pay. This was similar to the levels prevailing in 2007 on the eve of the financial crisis and well up to circa 30% prevailing earlier in 2022, which is close to the long-run average. He says, financial market conditions have now settled with long-term interest rates returning to the levels prevailing before the mini-budget. However, mortgage rates are taking longer to normalise and activity levels in the housing market have shown few signs of recovery, and house prices saw 3 successive monthly declines since September, the worst run since 2008. The more recent weakness may, in part, reflect an early start of the usual seasonal slowdown, with potential buyers opting to wait until the new year to see how mortgage rates evolve before looking to transact. But it will be hard for the market to regain much momentum with economic headwinds set to strengthen. As real earnings fall further, the Bank of England moves interest rates higher, and with the labour market widely projected to weaken as the economy shrinks. He says the risks are skewed to the downside, but there's still a good chance that we can achieve a relatively soft landing next year, with activity stabilising modestly below pre-pandemic levels. House prices will edge lower potentially, perhaps by around 5%. Excuse me. The Bank of England is likely to raise interest rates a little higher, although in recent years most borrowers have opted for fixed rate mortgages which are linked to longer term interest rates, so that may already have peaked. If so, this will help provide some support to affordability, as will solid gains in nominal earnings growth and modestly lower house prices. While the labour market is expected to soften, most expect the deterioration to be modest. Many forecasters, including nationwide, expect the unemployment rate to rise to around 5% in the years ahead. This would represent a significant rise from its current 3.7%, but would still be low by historic standards. Moreover, household balance sheets remain in good shape with significant protection from higher borrowing costs, at least for a certain period, with around 85% of mortgage balances on fixed interest rates. Finally, we're going to move on to the Zoopla December report, which is out today. And these report buy in cities. There are 8 key points. Our UK house prices increased by 7.2% over 2022. Quarterly growth has slowed rapidly and is set to move negative as of the start of next year. Discounts to asking prices are around 4%. Buyer demand is 50% lower than last year. New sales agreed 28% lower. Affordability and value for money are key to the outlook for 2023. House prices in affordable markets are less exposed to higher mortgage rates than in high-value markets where prices have underperformed. The flight to rural and coastal areas has moved into reverse. Flats in urban areas are expected to fare better in 2023. So that's the end of the Zoopla report. So there we have it. Market Wrap 132, Carnage in the buy-to-let market, possible soft landing according to Nationwide. It's a bit of a mixed bag. Really, as we always say, it's time in the market, not timing the market. So if you're going to buy anyway. But just make sure it's on a solid financial backdrop, i.e. make sure you have a good deposit. I've spoken to quite a few clients this week who are surprised to hear that as expatriates you need at least 30% deposit. That's a good thing actually, because it reduces your risk. It's worth saving a bit longer to actually get a better deposit. Thank you very much for watching. Do subscribe. We've got quite a few new subscribers this week. And as I'm in South Wales, bit of a surge from there. Let's keep it going. Thanks very much. Take care.